Do that.
Right.
Everyone's here.
Welcome, everyone. We'll get started in a bit.
Let's go. It's time, right? It is time.
Okay, I think we could get started.
Yeah, we can go
Okay,
ahead and get
so
started.
You want me to mute?
let me just admit this one. Got it. All right, so welcome back, everyone. It's good to see all of our returning members here at week 3 for the Real Estate Association. Today we have with us Dr. Professor Anthony Orlando, who will introduce shortly. Just a couple of quick announcements. We are in the search for our first in-person meeting will be within the next couple of weeks. We're just finalizing details on that. And also, for all paid members, if you should have received an invitation from your MyBar. So check your MyBar and accept that invitation if you haven't done so already. We are finalizing our paid membership packages. So once we receive our shipments, we'll set a time and date for you all to pick those up. We also have our first off-campus event, which we'll be talking about later in this meeting. And lastly, I just want to introduce our new board members, Jason and Prijan, and I'll just give them 30 seconds each to just introduce themselves.
Sure. I guess I'll go first. Hey, everybody. I'm Jason Valencia. I'm the new assistant marketing director, and I'm super honored to be a part of the team and just really help the club's goals of making real estate opportunities and knowledge super accessible to every student on campus. A little bit of background on me. I'm a transfer student actually from Santa Monica College. This is my first semester at CPP. I'm an FRL major and I'm taking the real estate focus. And in terms of work experience, I've been at a couple firms already. I've interned for CBRE, Cushman & Wakefield, Parks and Millichap, to name a few. And currently right now I'm working on the accounting team for Moss & Co. Property Management. And yeah, the job is great. That's pretty much a quick background on me. So if anybody wants to reach out, I'll drop my LinkedIn in the chat and you guys can connect with me.
Hello, everyone. My name is Prijan Pugh, and I am the scheduler for the Real Estate Association. I am in my 4th year at Cal Poly Pomona with a major in business administration and an emphasis in real estate. I look forward to working with the team and meeting all of you guys as well. And I hope everyone has a wonderful semester.
All right. Thank you, Jason and Prijan. We'll move forward and give the floor to Kyra and Jolie to speak about upcoming opportunities.
Hey team, so we have this awesome opportunity brought to us by Crew. It's a scholarship for all our females. And I'm gonna go ahead and let Kyra give you guys a little more information on that opportunity and what it's entailed.
So the scholarship can offer you a 1-year membership for both men and women. The scholarship is like mostly for women, but men can also apply. So we encourage all members to apply. And then there's plenty of mentoring and networking opportunities in the scholarship that could lead to either like jobs, post-grad, or internships too.
Awesome. Thank you.
Great. And here we have a CCIM event, which will highlight the Aries Hotel success story. So if you guys aren't familiar already, the Aries family, they've been a leader in the California residential and commercial real estate industry for over a century. And the event will pretty much highlight the stories from different generations since they've been around for so long of the family, like for how they became successful in the past, how they're currently being successful today, and what they're planning in the future. And so it is Thursday, September 22nd, from 11 a.m. to 1 p.m. and students only get to pay $25. So it's still a great opportunity. Keep in mind it's during our meeting, but if this opportunity better suits your needs, please feel free very great leaders here that they'll give amazing stories and presentations. And then real quick, for those who don't know what CCIM is, it's a certification. It stands for Certified Commercial Investment Member, and it's pretty much recognized by experts all around in the commercial and investment real estate industry. So if you're looking to get more expertise or knowledge in that investment area, it's a great certification to go for, and you'll learn a lot.
So what's up, guys? So there is like an ICSC event coming up. ICSC is even though they specialize in focusing on retail. I was at an ICSC event back in Vegas, and it was amazing. At ICSC, the typical events like this, you eventually will get to see a lot of companies, a lot of real estate companies, a lot of just any companies that relate to retails. All the big companies are going to be there, JOL, CBRE, or whatever it is, all the REITs, and there will be a lot of owners. Also, they have a really good students programs that will help you to accelerate in your career. There will be a lot of guest speakers event on these dates, and there will be also there's also food too, so it's gonna be awesome. If you guys really interested to go and join us at because our team will be going to San Diego, and we are gathering into a group, and we'll be going to the event. If you're interested to join us, please reach out to me directly. I will be sending I'll put my email and my phone number in the chat, and if you're interested, please send me a text and we can talk more about it.
All right, great. And so we're about to start our presentation. And so I encourage everyone to take out a piece of paper, pencil or pen, and get prepared to take notes. We have an amazing presentation here from Professor Orlando. And so we also encourage you, to turn your cameras on, participate, ask questions. And then any questions you do have, you could either jot them down or you can type them in the Zoom chat. So we'll be able to get to your questions towards the end of the presentation or whenever Professor Orlando allows for it. And so you could also raise your hand as well, and we'll pick on you. So yeah, just get ready to take notes. It's going to be a great presentation right now.
Okay, so now at this time, I'd like to introduce and welcome Dr. Professor Anthony Orlando. Professor Orlando is a professor in the Finance, Real Estate, and Law Department here at Cal Poly Pomona. Professor Orlando has studied at the Wharton School of Pennsylvania, where he received his bachelor's degree, from which he then went to receive his master's at the London School of Economics and Political Science, and ultimately finishing his studies at USC, where he received his PhD. Professor Orlando, it's a pleasure to have you here with us, and the floor is all yours.
Thank you. Thanks for having me. Like Marvin said, feel free to ask questions along the way. I'm happy to. I'll try to keep an eye on the chat, and I'll try to keep an eye on anybody who raises their hand. One quick thing about the Crew Scholarship: we usually win at least one, if not multiple, Crew Scholarships a year at Cal Poly, and I'm pretty proud of that. I want to keep that track record going. So anybody who wants to apply, if you need a letter of recommendation, feel free to email me. Even if you're not in my class, just let me know, send me a copy of your resume, and I can write a letter that I'll brag about you. So we'll try to get all that money to come to Cal Poly and screw all the other universities. Okay, I've got a couple things to talk about today. I have done these things a bunch of times now, so I was asking some people what they wanted me to talk about, and I got a couple of different ideas. One is some people wanted to hear about different careers that are out there in real estate. A lot of people don't realize just how many different jobs you can do in this industry. And so if you're still not sure about where to go, what kind of jobs to apply for, what works for you, I want to talk through some of those things. Before I jump into that, though, some of you know that I was at Cambridge University over in England last week, and I was presenting some of my research, which is on, this particular research was on mortgage fraud and mortgage-backed security fraud. And I know a lot of you are interested in the research that I do, so I thought I'd give you basically the presentation that I gave to them, with a few changes here and there. So I'm going to give you a couple of things today. So you get a little bit of my research and you get a little bit of other careers, and then we can talk about careers in research. We can put it all together. So let me just share a few slides and we'll talk about this. Why did I get interested in fraud and hidden risks? Well, I was in your shoes when the Great Recession happened. I was graduating into the workforce right around the time when the housing bubble was crashing and the financial crisis was happening. I didn't think I was going to have a career in real estate. That wasn't the plan. The plan was to have a career in finance, and it turned out that the entire financial world was imploding because of real estate. So suddenly I started taking an interest, and I started doing research on what was causing the problem. I started working with people who were experts specifically in the mortgage-backed security market. And I really haven't stopped ever since. I mean, even though I've gone off and done a lot of different things in real estate, this is still an endlessly fascinating topic. One major reason is because it's still relevant. I'm going to argue that a lot of the things that you're going to see in this presentation are still issues today. Now, one of the things that got me to the Cambridge conference was my working relationship with another professor at Cal Poly. Some of you have probably had classes with Professor Mutaseb, Majed Mutaseb. He focuses more on portfolio management and portfolio theory. He's worked in the hedge fund industry, so high-level investment strategy, which I've done some work in that too, but he doesn't focus as much on real estate. He was going to this conference because he's done a lot of work on hedge fund fraud. And I thought, well, you know, there's a relationship between these two things, because a lot of hedge funds were investing in mortgage-backed securities back during the housing bubble. And they are starting to invest in these types of securities again. So there's reasons to be concerned going forward. So it's actually securities fraud that's going to be our way into thinking about the mortgage world today. Here's one example of that. So you can see this article was written in 2007. So this was a Wall Street Journal article right when the bubble was starting to pop. Now, the crisis didn't really hit until 2008, but the big banks were starting to lose money in 2007. They were starting to write down the value of the loans that they'd invested in and that they'd packaged and sold on Wall Street. So for anybody who doesn't know, when I talk about mortgage-backed securities, all I'm talking about is firms on Wall Street going around the country and buying up mortgages, taking them away from the banks and the other lenders, so that when you pay your mortgage payment, the money doesn't go to the bank anymore. It goes to somebody on Wall Street. They've transferred that entire asset, and the investors on Wall Street are now earning that. But if you default on that mortgage payment, well, then it's the people on Wall Street who lose money. And since big banks like Citigroup were doing this business, their shareholders were suddenly concerned that they were losing a whole bunch of money, particularly because, and this is the key part, the shareholders felt that they didn't know what was going on. And that could be fraud, not necessarily. Now, a shareholder doesn't know everything that the company is doing. You just can't. So you have to figure out where to draw the line. What is information that shareholders have to know? They can't know every single decision that's made every day. That's impossible. But if it is material information that would greatly affect the value of the stock price, they're supposed to have that information. So something is wrong if they don't know, when they invest in Citigroup, that Citigroup is exposed to these very, very risky loans that could go belly up. That still doesn't make it fraud, though. Something is wrong, but it could be accidentally wrong. Could be something wrong with their internal controls. Maybe they're not documenting things well enough, or somehow they just didn't know that it was so bad that the shareholders should know about it. Maybe they thought the investment was perfectly safe. Where it's fraud is if there's an intent to deceive. If the managers knew how bad everything was and they didn't tell the shareholders because they didn't want the share price to change, that's fraud. That's material information that the shareholders deserve to have. Now, what you have to distinguish between is two levels of fraud that are happening here. There's the fraud at the level of the mortgage itself, which is where loans are being issued that shouldn't be issued. And then there's the fraud at the level of the securitization, which is that the investors on Wall Street didn't know what they were buying. We're going to talk about both of those, try to separate them out. So that's the first two things that I want to do in this presentation. And then the second two things is talk about, well, what do we take away from the types of fraud that may have occurred during that bubble period? First of all, did we deal with it appropriately in the decade since then? And, oh, it's been 15 years since that lawsuit was filed against Citigroup. Did we deal with it correctly? Did that lawsuit work? Have we put laws in place that might be helpful? And if not, what are the future risks to the marketplace when you go out into the marketplace and you might be exposed to this fraud, both as a borrower and as an investor? Now, one of the things that got me, that got me so fascinated with all of this stuff was hearing the stories about what was happening at some of these lenders. I'm sure when you go out into the world, you all are going to try to be ethical in your work, I hope. But there were a lot of lenders from 2000 to 2006 who took advantage of these rising prices and these lax lending standards by basically issuing loans that never should have been issued, loans that the regulators wouldn't have allowed them to lend, loans that people on Wall Street never would have purchased if they'd known the truth. That's all fraudulent. And so we hear stories, and I'm going to give you direct quotes from some of the leading subprime lenders at the time. Here's a mortgage salesperson who said 50% of my customers were bullied into doing their loans, 50%. Here's another loan salesperson who said every closing that we had was really a bait and switch because you could never get them to the table if you were honest. And then here's one of the executives who hired those salespeople. They said, we didn't want anybody with experience. You wanted people who were hungry, motivated. You wanted to brainwash them your own way. But my favorite quote is the moniker that they gave to the room in the office where they would intentionally deceive everybody, the regulators. They would literally doctor the documents to pretend like the loans were going to people that they weren't. They called it the art department. That was where they forged the legal documents so that they could issue the loans. Now, the question that you got to ask, if you really want to understand something like this, is, are these just one-off statements? Are these quotes really the case for most of the industry, or were these just a few bad apples? Because if it's a few bad apples, we're not talking about fraud being a serious problem. It's not driving the housing bubble. But if this was pervasive throughout the industry, well, then you've got a systemic problem. You don't just have a few bad apples. You've got to change the way the system operates to prevent this from happening again. So part of my job as an economist is to dig into the numbers and figure out how much does this actually happen. There are a few ways we can measure it. One type of mortgage fraud is where they would not report if there was a second loan on the property. Anybody who's taken my class, we talk a lot about how important leverage is, how important the loan to value ratio is. And the bigger that ratio is, the riskier the loan is, because the more leverage you take on, the more risk you take on. So it's important to understand the total amount of leverage that a person has. How much do they owe? Not just the first loan, but if there's a second loan on top of it. And so in order to convince investors and regulators that these borrowers were perfectly safe, they would just not report the second loan, and it would look like they were less leveraged than they were. Now we can go back after the fact and we can match up what they said with other databases that we have where we can track the borrowers over time, and we can tell if they had a second loan but it wasn't reported. That's one type of mortgage fraud. Second kind is if they misreport whether or not the person is actually living in the property. People who live in the property are more likely to repay their loans. They're more invested in it. So you might say the person is an owner occupier even though they're not, because it makes them look better. Another is the appraisal could be overinflated. You could say the house is worth more than it is. Now, who's to determine what overinflated is? I mean, who's to say what a real value is? Isn't it subjective? Well, we've got statistical models where we can figure out on average what a house should be worth with those characteristics. A 3-bedroom, 2-bath house in a particular neighborhood. We know about what that should be worth, give or take a little bit of money. And so overinflated means the number is so high that there's no way that it could possibly be worth that based on the statistics. So we can measure that too. A couple other types of mortgage fraud that I'm not going to focus on in this presentation, just because we don't have good data for them. You could misstate the income. You could say the person is earning $200,000 a year and they're only earning $50,000, makes them seem like a better borrower, or you could do the same thing with their assets. Those things are harder to measure, so we'll put those aside. Let's focus on those first 3 types of mortgage fraud. This graph has all 3 of them measured over time from 2002 to 2007. So a good chunk of the housing bubble and when it's starting to come down a little bit. That black line, that's housing prices. Okay. Those bars, those empty bars, that's the number of loans being originated. So you can see both of those numbers going up and down over time. Now, what we want to see is if the other lines go up and down with it, because that would be an indication that maybe those things are driving it. So for example, look at the green line with the little triangles. That's owner occupancy misreporting. That doesn't change. It just seems to be flat. It doesn't go up with housing prices. It doesn't come down with housing prices. Doesn't seem like that is driving the problem. What about the red line? Appraisal overstatement. It seems to go up a little bit at the end, but in general, pretty flat. Fluctuations here and there. Doesn't seem like that's necessarily driving the problem. But the blue line inches upwards from 2002 to 2003 to 2004 to 2005, and then it starts coming down. And shortly after it starts coming down, so do the other measures of the housing market. So here's some evidence that the non-reporting of the second lien might actually be a significant factor in driving mortgage fraud. Now, I didn't know that before I taught all of you in our classes that leverage was so important, but we had previous evidence to suggest that leverage was important. So I'm not surprised to see it. It fits with what we know about loan-to-value ratios. If people have too much leverage, they're more likely to default on their mortgages. And so that would be a good way to convince the market that they're actually safe, is by not telling you how leveraged they actually are. Now, who were getting the loans that were fraudulent? I've got 2 graphs here. One is low or no documentation loans. The other is full documentation loans. Low or no documentation means they didn't provide any information to document what their incomes were and what their credit scores were. Nowadays, it's very unlikely to find low or no documentation loans. Lenders are very, very careful. But back then, a lot of the lenders were much less careful about it, very careless. So with both of these, though, you see a similar pattern. Okay, first thing you see is what? The line's going down. Well, what does that mean? On the x-axis are the credit scores. It means that the likelihood of defaulting on a loan was higher for the people with lower credit scores. No surprise there. That's what credit scores are there for, right? They're supposed to indicate how risky a borrower is. What's really interesting is the gap between the blue dots and the red dots. That gap only appears for the lower credit scores. I mean, it's only really big for the lower credit scores. And it seems to get bigger as you move to the left. The blue dots are the loans where there was misreporting, potential fraud, where they didn't report that the borrower had a second lien. The red dots are the ones where everything was fine. And what do you see? Whenever there is misreporting, the likelihood of delinquency, of defaulting on a mortgage, goes up. But it really goes up for the people with the low credit scores, which suggests that the lenders were intentionally misreporting the second lien because they knew that those borrowers were likely to default. And it was specifically those subprime borrowers who they were trying to sneak in without anybody noticing. Here's another piece of evidence that suggests that this was seriously important to the housing bubble. I've got two lines here. The black line, let's start with the blue line. The blue line shows you the zip codes in the United States where the worst offenders were operating. Okay? By the worst offenders, I mean, take all the lenders that are out there during the housing bubble and identify the ones who were most likely to not report a second lien. They're the worst offenders, right? They're the bad apples. And then pick out the neighborhoods where they have more than 10% market share. Those neighborhoods where the worst offenders are operating, that's the blue line. That's the housing prices. The black line is all the other neighborhoods in America. In other words, the neighborhoods that these lenders are focusing on, where they're committing potential fraud, those are the neighborhoods that experience the worst boom and the worst bust. The bubble was way more severe in places where this misreporting was happening, which suggests, yeah, it kind of mattered, didn't it? I mean, the bubble probably wouldn't have been as bad if the whole country looked more like the black line than the blue line. And that means that the recession wouldn't have been as bad, because you can see that the black line doesn't fall as much. So it seems that this type of mortgage fraud was a significant driver of the housing bubble. Now let's bring Wall Street into the equation. One of the arguments for why mortgage lenders were suddenly doing things that they'd never done before, why they were issuing loans that they shouldn't issue, was because all of a sudden they had the ability in the early 2000s to sell those loans to Wall Street. If the lenders have that option, why do they care if the loans are bad? Sure, issue risky loans. It's not going to be your problem because you're going to turn around and sell it to somebody else. And so if the borrowers default, it's not you who loses money, it's the investors on Wall Street who bought the loans away from you. How do we test this? How do we know if that, I mean, that's just a hypothesis. How do we know if that's actually happening? Well, one interesting way is there are these thresholds where Wall Street is significantly more likely to purchase a mortgage loan if the borrower is above a certain credit score. And that threshold tends to be right around 620. Sometimes I'll say it's between 600 and 620. Let's say that. It's not always a hard and fast threshold. If you have a credit score above that, your loan can probably be sold to Wall Street. Below that, they're probably not going to take it. They'll take subprime, but they won't take too much subprime, if you see what I'm saying. Well, that's interesting because that's a little experiment. If your goal as a lender is really just to pass these loans on to Wall Street and get it over with, then you really only want to issue loans that are to borrowers above that threshold. Now, look at the graph on the left here. You see that huge spike right around 620? That means that borrowers who were just above that threshold were far, far more likely to be getting a loan where the lender was not reporting the second lien. In other words, they were far, far more likely to be getting one of those fraudulent loans. So this is evidence that the lenders aren't committing fraud indiscriminately. No, it's not for every type of loan. They are specifically committing that fraud for the loans that are the hardest to convince Wall Street to buy, the ones that are just above that threshold. They want to get rid of their riskiest loans. And they want to convince Wall Street that they're not that risky. And so that's where they're most likely to lie in the documentation. So it turns out that the securities fraud that I started this story with, happening on Wall Street, is directly related to the mortgage fraud that's happening in the lending industry. Because it is the act of securitization which is giving lenders the motivation to commit that fraud. That doesn't mean that that Wall Street is aware that it's happening. No, we're going to have to come to that in a minute. But it does mean that as private label securitization, and let me pause there because I just threw a term at you. What private label securitization means is Wall Street is doing the securitization, not Fannie Mae, not Freddie Mac, not any government agency. Wall Street, that's what it means. That was the unique fact in the early 21st century. That's what was driving this. So it is the act of private label securitization that is giving lenders the motivation to commit fraud, because they know that if they do it right and they do it for the right borrowers, they'll be able to pass some truly risky loans onto Wall Street and make a bunch of money before Wall Street, before anybody really notices what's going on. All right, now I see Martin asked about the tranches. I'm going to come back to those. You're absolutely right. That's exactly right. I'm going to come back to that. So what Martin's asking about is, what did the securitizers do with the mortgages once they got them? And the answer is, they didn't just sell them to investors by themselves. They actually structured them in a certain way so that different investors could get different levels of risky investments. Now, the question now is, who do you blame in all of this? Okay. I was involved in a couple of the lawsuits around 2008, 2009, 2010. I was on the expert witness side. And this was the question that the lawsuits really boiled down to on Wall Street. It was securitizers on Wall Street saying, we had no idea what was going on. If these loans were fraudulent, it was unknown to us, not our fault. We have an information asymmetry, which is economics jargon for somebody knows something that somebody else doesn't. The originators are issuing the loans. They know who the borrowers are and how risky the borrowers are. On Wall Street, we're taking their word for it. We've never met the borrowers. We don't know if they have a second lien. We don't know what their real income is. We are in the dark. We don't have as much information. And that's why we have a contract. The originators signed a deal with us when they sold us the loans. And that deal includes what's called reps and warranties, or reps and warrants. Reps and warrants are a standard thing in contract law that basically say, we are representing to you the truth about what we're selling you. We're not lying to you. And so you can trust the product that we're giving you. And if you find out that we lied to you about what's in the product, we cover your losses, or we buy back the loans. That's what the lenders were saying to the securitizers. So the securitizers are saying, there's a breach of contract here. You issued fraudulent loans. You didn't tell us what you were doing. You sold those loans to us under false pretenses. You cover our losses. You pay for our investors who are so pissed off at us. The originators said, no. You knew what was going on, okay? You knew that we were sending you riskier and riskier loans. Maybe you didn't know the full extent of the fraud, but you should have done your due diligence. You had the ability to check out some of these borrowers and to figure out what was going on. And the way we know that you knew some of what was going on is that you then turned around and hid the full information about these loans to your investors. So don't tell us that you didn't know what was there. If you didn't know what was there, why didn't you want to tell your shareholders that you were exposed to so many subprime loans? Both sides have an interesting argument to make. I'll just lay out the debate like that and let you weigh in on how you feel about it later. But one thing is for sure, as this act of securitization ramped up and came crashing down, the amount of risky mortgage products that were being issued rose and fall almost identically in sync. I mean, it's just astonishing. When I made this graph, I didn't think the numbers were going to line up this perfectly. That almost never happens. So the amount of market share that the firms on Wall Street gained rose at almost the exact same rate as the market share of these risky mortgages. So while I think it's fair to argue that the securitizers didn't fully know the extent of the fraud that was going on, it's also pretty hilarious for them to argue that they didn't know that risk was rising, because their entire market share was being driven by these risky loan products. Even if they didn't know that they were all fraudulent, they had to know that the types of mortgages that were being sent over to them were riskier than anything that had been created previously. And they also had to know that as the subprime market was revving up and their securitization was pushing that market up, at the same time, it was pushing down the market for safe government insured mortgages, which is what the FHA mortgages are. They knew all of that. They may not have known every instance of fraud, but they knew all of that. They knew something fishy was going on. And one last piece of evidence that they knew something fishy was going on was coming back to Martin's point, what they then chose to do with those mortgages. Now, I'm not going to explain this entire graph because I don't want to dive too deep into how to structure a mortgage-backed security. But here's the basic point. They had these different mortgage-backed securities. That's what those three cones are that are lined up in a row. And they would structure them in a way so that some lenders would get paid back, some investors would get paid back before others. And that meant that they were getting safer investments. That's the AAAs. So if you structure the timing, then you can say, okay, if there are any defaults, the people who get paid back first are probably safe, but the people who are supposed to get paid back at the end, there might not be any money left over for them. So they'll take the brunt of the defaults. So what you've done is actually a very clever thing, and it's not necessarily a bad thing. You have structured those mortgages so that there are some people who get a safer payout structure and others who get a riskier one. And that's pretty nice because that means that different types of investors can buy different types of shares that fit with their business model. A pension fund or a life insurance company who's only supposed to invest in AAA mortgages, they can invest, AAA investments, they can invest in the safe pieces or tranches as we call them. And then hedge funds who are willing to take big risks, they can invest in the bottom tranches, which are the ones that get paid back the last, and therefore are the most vulnerable to losing out. Okay, all of that's fine. But then the really interesting thing is they would then take those investments and they would repackage them. They would take the bottom pieces, the really risky pieces of those, and they would repackage them into another security that operated the same way, and that was a collateralized debt obligation. That's the cone all the way on the right. Now, why would you restructure it and try to create more safe assets unless you thought that those bottom tranches were so risky that nobody would want to invest in them unless you did that? You had to know that you were selling them a product that was likely to default. Otherwise, you wouldn't have needed to go through all of that hassle to try to make some of them look safe. Who was invested in the different pieces of this CDO? Well, the really safe pieces on the left-hand side, everybody had a piece of the puzzle, but you can see the banks were much more, that's the gray pieces. The banks were much more invested in the safe pieces. And the hedge funds on the right, that's the orange pieces. Man, the hedge funds were really invested in the risky pieces. And another way to look at that is, instead of breaking it down with the different credit ratings on the x-axis, I can put the different institutions on the x-axis. And now you can see the insurance companies, almost entirely green, right? They're mostly investing in the safe stuff. Banks are mostly investing in the safe stuff. Hedge funds, over 40% of their investments were in the equity tranche, which was the lowest, riskiest tranche. So the banks and the insurance companies are really benefiting from structuring these CDOs, because they are investing in these really, really risky loans, but they've been repackaged in a way where they look safe and they get a AAA rating. Now, here's why that's really important for our question of securities fraud. In order to prove securities fraud, what did I say you needed? You needed to prove intent to deceive. It could not simply be the fact that they invested in something bad. Otherwise, anybody who ever made money in the stock market would be guilty of fraud, right? No. What you have to prove is that the managers knew that the investments were risky, and that therefore they didn't tell their investors. But the managers point to a graph like this, and they say, look at all the green at the banks and the insurance companies. We were investing in AAA securities. We thought they were safe. We weren't trying to deceive anybody. All right. So how do we deal with this problem going forward? One way is you can deal with mortgage fraud at the origination level. You can put in place anti-predatory lending laws. We'll look at those for a couple of minutes. Another way you can do it is you can focus on Wall Street. Right now, really the main way to deal with that is the lawsuits themselves. And so we're going to look at how they work, you've heard both sides of the argument now. How did the securities fraud lawsuits turn out? Let's focus first on those lending laws that might deal with mortgage fraud at the origination level. State of Illinois had a predatory lending pilot program. What it said was, if you were getting a risky product and you had a low credit score, then it would set off a flag, a red warning. And that red flag would then say, the regulators would say to you, you have to go to a home buying counseling meeting with an expert to talk through the loan before you sign the papers. We want an expert to sit down and look at the loan and make sure that you are getting a loan that is safe for you, because we think there's a possibility that you might get taken advantage of. That's what predatory lending is. When they put that pilot program in place, you can see right here, this blue line, that is what happened to the market share for the really bad originators when that pilot program was put in place in 2006. The originators who were most likely to commit that fraud dropped way down. As soon as you put the anti-predatory lending law in place and you said, wait a second, before you get that loan, we need you to talk to somebody, all of a sudden the bad originators just left the market. They don't want to be there because they know that they're going to get called up. They're going to get called out. They're going to get caught. And as a result, you have a big drop in market share for them that you don't see to the same extent in the other zip codes, which is the black line. And as a result, if you look at the second graph, you see that in those zip codes where that anti-predatory lending law was in place, the boom and the bust were much less severe. So it seems that an anti-predatory lending law kind of worked. Now, Illinois wasn't the only one, but I think that they did it really nicely where you could compare some zip codes with other zip codes, and you've got this nice little experiment. But we can look across the country at all different states that had anti-predatory lending laws. And what do we find? We find that when those anti-predatory lending laws were put in place, the bubble was much less severe. That's the blue line again, compared to the states that didn't have those lending laws put in place. When the law went into effect, it muted the bubble by cutting down on mortgage fraud. So one lesson from the crisis is that you can just cut things off right at the beginning by making sure that if people don't have financial literacy, at least they have somebody whispering in their ear the right thing to do. And you can prevent the thing from getting out of hand in the first place. That's if you can put a law like that in place. If you can't, the other way to deal with it is to look on Wall Street. So let's come back to the story that I started my presentation with, Citigroup. How did that lawsuit turn out? Remember, it was 2007 when they issued the lawsuit. Let's rewind the clock a little bit and talk about where the lawsuit came from. Here's what happened. In July of 2007, Citigroup told its investors that it only had $13 billion in exposure to subprime mortgages. That sounds like a big number, but it's not a big number compared to their overall book of business. But they weren't telling the truth. They failed to disclose an additional $39 billion of exposure to subprime CDOs. And their excuse was that they didn't think that there was anything wrong with those CDOs. Remember that graph I showed you right here? They're looking at the big green bar and they're saying, look, we don't need to report exposure. There's no exposure. We only lose money if these AAA securities default. And AAA securities almost never default. We bought safe securities. That's not real exposure. We don't need to report it. We don't report AAA securities most of the time when we report exposure. We only need to report the things that are really vulnerable to losing money. This is not material information that the shareholders need to know about. October of 2007, they issue another statement to shareholders. They stick with the $13 billion number. November 4th, 2007, the market is collapsing and they say, oh, you know, we actually forgot to tell you about these other $39 billion. Sorry about that. By the way, we think we're probably going to lose like $8 to $11 billion. Just so you know, just forgot to tell you. Oops. And the shareholders say, oh my God, you're kidding. And the shareholders filed that lawsuit. In the year after the shareholders filed that lawsuit, Citigroup loses 90% of its stock value. And if they hadn't been bailed out from the government, they probably would have filed for bankruptcy. So do you think that that information was material? They could have bailed out a lot sooner, right? The shareholders could have gotten out a lot sooner, maybe if they'd known that. So what's the situation that you face if you're trying to prove that it's securities fraud? Remember, it's not that easy to prove. Corporate managers have to have superior knowledge relative to investors. We don't have public statements contradicting what they're saying. They're not saying one thing in private meetings and then saying another in public. At least we don't have evidence of that. So we don't have direct evidence that they had superior knowledge, that they lied. We can't say that they committed fraud just because the loans went belly up. That's called the hindsight doctrine. Citigroup says, we really believed that these things were safe. We didn't try to defraud you. We were just as surprised as you were. And their other argument is loss causation. They argue our share price did not lose value because of that exposure. So even though you lost money, you didn't lose money because of the subprime securities. We would have lost 90% of our value anyway because it was a massive financial crisis out of our control. It had nothing to do with that particular statement. And in order for it to be fraud, you have to prove that the shareholders lost their money because Citigroup didn't tell them that. and I'll skip past the last couple of things. I'll leave it to you to see whether you agree with them or with the shareholders. They eventually settled the lawsuit, and pretty much all the lawsuits that came out of the financial crisis were settled. They didn't go to prosecution. The question now that I want to leave you with is, where do we go from here? This is a measure of the volume of private label securitization. You can see how it shot up from 2000 to 2006. That's the bubble period. And then it came crashing down. And for almost a decade after the Great Recession, the market lay dormant. Very, very little private label securitization was happening. Wall Street didn't want to get burned again. But notice what starts happening. 2016, 17, 18, 2021, it's been inching upwards every year. Now, I don't know what's going to happen this year because the economy is slowing down a little bit. So maybe the number won't be that high. But before we got into this moment where the market's been slowing down, it certainly seemed like Wall Street was starting to get comfortable again with doing this. And that's problematic, isn't it? Because we know that it was this act of securitization that gave lenders the inspiration to commit fraud so that they could sell their loans to these securitizers. And we also know that when this type of securitization was happening and the riskiness of the market was ramping up, the possibility of securities fraud was also increasing. Whether you think what happened was securities fraud or not, it is very clear that the managers didn't tell the shareholders everything that the shareholders needed to know. Whether the managers did that honestly and they didn't mean to is a question for the lawyers. But clearly, a lot was being hidden from the shareholders, and that could happen again. And so I leave you with these future risks to be concerned about as you go out into the industry. Are we going to see private label securitization start to rise again? That would be concerning. We are starting to see a rise of what are called non-qualified mortgages, which is riskier mortgage products. We are starting to see that for the first time in a decade. That's concerning. We have seen the risk of non-bank lenders who are less regulated, and a lot of them have been going bankrupt this year as the mortgage market has collapsed. So that tells you how risky their business model is. And with inflation, I would argue it's become even more difficult for regulators to monitor this because it's costly to hire regulators, more costly than ever before as wages are going up, and they can't keep up with what's happening on Wall Street. Now, I know we're kind of running tight on time, so let me just wrap up here. That was the presentation that I gave in Cambridge. As always, I have more things to talk about than I have time, but I know that some of you wanted to talk a little bit about careers that you could have in real estate. And after hearing this presentation, I hope that none of those are fraudulent careers. We'll hope for the best, that these are ethical careers. I'll share these slides with everybody at REA, but I made this little diagram so that you can think through all the options that are out there for you. If anything that I've talked about today interests you, there's a profession out there in real estate for you, okay? First of all, I don't think people realize how many jobs are possible in the public sector. So it's not just the private sector. I know we're in a business school and you want to focus on the right-hand side of this diagram, but think about the left-hand side too, because you'd be really a valuable person with your training, with an FRL degree. You'd be a really valuable person for the government to hire. You know, the government has real estate assets to manage, and they have to do valuation of real estate assets for property taxes. That's assessment. And they need regulators who understand business so that they issue common sense regulations and not regulations that stifle valuable development. So that's just some of the jobs on the left-hand side here. On the right-hand side, you know, I think when people think about going into real estate, they just think about being a realtor. Well, that's brokerage, but you can see that's just one piece of the puzzle. You could build new real estate. That's construction and development. You could value real estate. That's appraisal. You could work in the investment side. You could work in property management. You could work in finance at a bank issuing loans. So what I encourage you to do in your free time is to go through this, see which of these things might be interesting to you. And if you want to talk about them further, email me, set up an appointment, let's talk. I'm happy to talk you through any of these things. I know all of these different types of jobs, and I know people who work in most of them, and we'll find which path is best for you. And again, if you enjoyed anything that I presented today, you should know that there's one other path that's available to you in real estate, and that's research. That's what I do. I teach and I research. I create knowledge, and then I pass it on to all of you. But I've got to create it too. That's what makes it interesting, right? If I keep teaching the same thing for 50 years, I'm going to get pretty bored. Well, one place you can do research is at a university. You could become a professor like me, but there's lots of other places you can do research. You can do research on Wall Street. You can do research at any of these places. And I know researchers who are at most of these places doing real estate research, uncovering new knowledge that everybody in the field then gets to use. Personally, I think creating knowledge is a really, really exciting life, and that's why I've chosen it. So I hope that if nothing else, you at least appreciate the work that goes into creating knowledge, and you try to make a habit throughout your life of sucking up as much of that new knowledge as you can so that you're always at the forefront and you're not the investor who's going to get deceived. Thanks, everybody.
Yeah, thank you, Professor Orlando. That was a lot of information. I know I was taking a lot of notes. The good thing is we'll be posting this on our YouTube channel for everyone to refer back to. But I think we can open it up to questions. I know we have a few in the chat, so Jolie will get to those.
Yes, so we have one question from Martin, and he said, what drove the trenches right were prime and subprime mortgages were packaged and rated incorrectly as less risky than they actually were?
Yeah, definitely. So that relates to that slide that I showed you that had the AAA and the AA and so on. To the point about being rated incorrectly, you're absolutely right. There's a couple reasons for that very briefly. The credit rating agencies have a business model where there's a significant possibility of conflict of interest. The credit rating agencies are supposed to decide whether or not an investment is safe. But here's the problem. They're being paid by the people who created the investments, right? It's as if a safety regulator were regulating a safety product like a cell phone, or let's think of something that would be more harmful, a car. A regulator who's regulating a car is supposed to decide whether the car is safe to drive in, but the person who's paying them is the car company. Well, of course, the car company wants to argue that the car is safe. They don't want people thinking their cars aren't safe. So if you work for the car company, you're more likely to tell them what they want to hear. That's the problem with the credit rating agencies. The other problem is more of a statistical problem, which is when they looked at those different tranches, they thought about them as independent investments. And that was a mistake because all of those tranches were filled with mortgages that were very similar, which means that if one tranche is going to default, it increases the likelihood that another tranche is going to default because it means the entire housing market might be in distress. In other words, there's a correlation between those investments, and they didn't take that into account at all.
And then there was just one more from Tamara. Since the 6-month US Treasury now yields basically the same as buying and renting a house in America, can you predict that a big real estate investor sell-off is coming, especially among Wall Street owners? And if so, so comparing this to the armed crisis in 2008, instead of a bunch of people defaulting, do you think it is now going to be big landlords? If so, why?
Let me answer the last question first. No, I don't think that it's going to be big landlords by and large. Most of the big landlords, and by big landlords, I'm thinking about either the REITs, like equity residential, or the buy to rent companies like American Homes for Rent or Invitation Homes. These companies are sitting on piles of cash. I know American Homes for Rent in particular was very, very smart about it, and they loaded up on cash. I mean, full disclosure, American Homes for Rent is run by Dave Singelin, who's a Cal Poly alum, so we know him. But I mean, I can just say that they loaded up on a ton of cash before the crisis happened, and they were kind of prepared for this. And also, you know, they're not, in general, the types of loans that were issued over the last 2.5 years were not the types of loans that were issued during the housing bubble in the early 2000s. It was mostly borrowers with good credit scores and good incomes who were getting it. That doesn't mean that housing prices aren't going to fall. They're already starting to fall. And I've been predicting that they're going to fall for a while now. But they're not going to fall to the same extent that they did back then, because we're not going to have the kind of foreclosure crisis that we had back then, because we don't have the same proliferation of risky mortgages. So it's going to be a different kind of a slowdown. It's not going to be the same kind of panic running for the exits. That's my prediction.
Awesome. Thank you so much. So we're gonna take some questions from people that have their hand raised. Nicolette, you can go first, and then Aiden, you can go right after.
Yeah, so I was wondering, was there anything like fraudulent happening, like you were discussing in like the commercial real estate side of any of it? Or was it just mainly residential? And then with that, like, is there any really solid notable risk in commercial real estate?
There's definitely risk. I'm not aware of any evidence of this kind of fraud happening on any large scale in commercial real estate. And I'll tell you one reason why. The commercial mortgage-backed security sector is very different from the residential mortgage-backed security sector. So the problem with residential mortgage-backed securities is that residential mortgages are small. And so if you're going to create a mortgage-backed security that's worth $500 million or $1 billion, which is what investors are looking for, you're going to have to pull together thousands and thousands, maybe hundreds of thousands of loans. And that means you can't possibly do due diligence on all of them. And that's the securitizer's excuse, right? And that allows the originators to get away with a lot of stuff because they know that the securitizers can't do due diligence on all of them. Commercial mortgage-backed securities are usually only backed by a handful of properties, sometimes only one. Sometimes there's just one mortgage in the entire mortgage-backed security because the property is worth $1 billion. I mean, if we're talking about gigantic skyscrapers in Manhattan, that's possible. What that means is the securitizers can do their due diligence. If you're thinking of investing in a commercial mortgage-backed security and there's only like 2 or 3 properties in there, you can find out everything you want about those properties. It doesn't take that long to look it up. And so you can find out for yourself whether those borrowers are worth investing in or not. And that means it's a lot harder to slip fraud past the investors.
Gotcha. Thank you.
Yeah, no problem.
Aiden, you have a question.
Yeah, for sure. Can you hear me correctly?
Yeah.
I know my service isn't the greatest. Okay. So you kind of answered my first question that I put into the chat, but then as a second question, could you recap again what CDOs are just one more time?
Sure. So think of it like the second layer of securitization. First, the mortgages come to Wall Street, and Wall Street does that slicing and dicing where they create a pool of mortgages, but then they sell shares in that pool to different investors. And they say some investors get paid back before others. And that means the ones who get paid back early, they get AAA rated because that's super safe. You're pretty sure that you're going to get your money back if you're the first ones to get paid back, but the ones at the bottom get really low ratings. The problem is the ones at the bottom that get those low ratings, not a lot of people want to buy them. I know one guy who was one of the originators of the private mortgage-backed securities market in the 1980s. And he used to say that they literally looked for suckers to buy that. He literally knew that he was selling crap. By the way, not a person I would go into business with. I'm not saying he's a friend. I just say I know him. So in the early 2000s, they were doing this at large scale. So they had a lot of crap and they had to figure out, how do we get people to buy it? So they took the bottom piece of one security and the bottom piece of another security and the bottom piece of another security and put them all into a completely new security and did that whole tranching all over again. And that's a CDO. It's the second layer of the securitization where you're trying to take the really risky parts from the first one and try to convince people that they're not so bad.
Okay, so like the CDOs are like what they're trying to sell to like Wall Street people.
Yeah. Yeah.
Okay,
Exactly.
all right, thank you.
Yeah, no problem.
Awesome question, Aiden. Okay, we're gonna go to Nicholas now.
Hi, I don't really have a question on the material you taught today, but I do have a question on what are some of the strategies you use to give a compelling presentation, mainly on the speaking side and less on like how to format PowerPoints and stuff. Because like I found myself like so encaptured in your presentation, and I thought that was like really amazing.
Okay, so first of all, that's a compliment, so thank you, I appreciate it. So I will tell you what my philosophy is, but I will also admit that a lot of people disagree with me on this. So if you like the way I did it, maybe you'll like this, but I have arguments with people about this. I had a professor once who told me that if somebody misses your presentation, they don't get to see it, and afterwards you send them the slide deck, but they weren't there, they shouldn't understand what's going on at all. If somebody flips through your slides without you, they should be completely lost. And the reason he said that is because he said, the point of the presentation is to go listen to you talk. Anything that's on the slides should be helping to make your point, but it shouldn't be the presentation itself. So one thing that you never see me do is put a whole bunch of bullet points that are basically talking points. The talking points are in my head. If I want to say something, I'll say it. You don't need to read it. And I don't read my slides either. So I make my slides as sparse as possible. I only want to show you something that I can't really do well with my words. So a graph is great because I can try to explain a graph to you, but it's better if you see it. And every once in a while, I'll put bullet points up if there's like 2 or 3 takeaways that I want you to like really focus in on. But other than that, keep them as sparse as possible. Not everybody agrees with that. Some people think that a PowerPoint should be something that you can read afterwards and you can know everything that the person said. Like it's a full summary of what they said. Problem with that is those slides are really boring during the presentation, right? And they give you the they make you feel like you can just read off of them, which you really shouldn't do. So, yeah.
Yeah, Professor. Can you tell us like what type of research projects are you working on, right now? So, if it's related to real estate or specifically, I don't know, whatever it is in real estate, maybe people in like us can participate and help you out.
Yeah. Okay. So, I mean, they're all over the place right now. I've got one project where we're looking at when conforming loan limits change, when the regulators change the limit for what's the maximum level of loan that Fannie and Freddie will purchase. How does that affect housing prices? Because if Fannie and Freddie are willing to purchase bigger mortgages, does that push up housing prices in different neighborhoods? So that's one. We're just wrapping up that project. I'm actually doing that with Professor Welke, who you all know. I've got an ongoing research project where we're trying to understand what's standing in the way of building more housing supply, because that's a real problem in major metropolitan areas. And we're trying to understand why that's becoming increasingly different, even in small cities, not just big cities like Los Angeles. And our running theory is that it's not just the big blue cities with high regulations, that even cities like Austin and Denver and Raleigh are going to become increasingly expensive too, because there are problems in the marketplace too, that frictions that prevent construction from responding. I've got a project where we're measuring how long it takes to build real estate. And we're also using that same database to measure whether office buildings are more likely to be converted into residential buildings right now. I mean, that's just a few of them. I've always got a lot of stuff going on. I would say if you're interested in getting involved in research, send me an email and we can talk about it, and we'll take it from there, because I'd like to see what each person's interest is in it, whether it's a career interest or you just want to get a taste of it while you're in college, and then we can figure out what's the right path for you.
Yes, sir. Yeah, I will. I'll reach out to you, and maybe you can send me some of the research that you have available.
Sure.
I'll blast it out for some students because some students, they really need some experience. Like example, if they don't have internship, maybe research will help them to get
Yeah.
involved in the career.
Sure.
And yeah, all right. That's it.
I think we just have one more question from Aiden, and I think we will
We
be.
wrap it up. Yeah.
Yeah. So you mentioned like throughout your philosophy and your presentation about how like companies like Fannie and Freddie or people on Wall Street are like buying houses and whatnot. And you also have predatory lending that are also inflating prices, but then also crashing prices at the same time later on.
Mhm.
What are ways on a personal level or on a business level that like we can avoid that without necessarily having to do like a huge deep dive like you have done in this sector right here?
Yeah. Yeah. I mean, financial literacy in general is the best way to protect yourself, which means, first of all, most of you are getting an FRL degree, so you're going to have a pretty good background in how finance works. You'll have a pretty good idea of whether you're looking at a predatory loan or not. But I mean, for most borrowers, a fixed rate mortgage is what they want to go with, and a long-term mortgage, 30-year fixed rate, maybe 15-year fixed rate, depending on your situation. Adjustable rate mortgages are much riskier for borrowers. You should only do it if you are on a career path where you're pretty darn sure that your income can meet rising interest payments. Or if you know, you can do a hybrid arm if it's got an early fixed rate period, if you're pretty sure that you're going to sell the house after that fixed rate period. And so you don't have to worry about when it starts adjusting, but like that's a risky move. And I would say, stick with the reputable lenders. And if you can, get recommendations from friends of yours who've gotten mortgages before so that you're working with a good lending officer. I can tell you, if you email me, I can tell you who I've worked with in the past, who I think is reputable, but, get recommendations from other people. And finally, just follow the news. I mean, I can teach you the basics about financial literacy, but the sad fact is that predatory lenders are always coming up with new ways to do stuff. So you got to follow the financial news throughout your whole career so that you're always up on what the latest scams are and you're able to avoid them.
Okay. Would you be able to drop your email in so then maybe I can
Yeah, here you go.
link up with you? Thank you.
There you go. Yeah.
Perfect.
No problem.
Sweet. Thank you.
Yep.
Okay, well, thank you, Professor Orlando, for coming to our real estate association. It's always a pleasure to have you. Would it be okay if people reached you on LinkedIn as well?
Yeah, absolutely. I don't have the link right now, but it should be easy to find me.
Okay, yeah, we'll share it with our members.
Yeah.
But just want to thank everybody else for coming out. It was a great meeting, and we'll see you next week for week 4.
Take care, everybody. Thanks, everyone.
Thank you,
Thank
Professor.
Have a great day, Professor.
Thank you.
Thank you so much.
Thanks so much.
I didn't expect it to dip up.
Okay. All right, boys and gals.
All right, we could finish recording.